I was at a party on Saturday night listening to a guy talk about how he wished that he got into rally car racing when he was younger. The guys in the pro sphere now all started when they were 6 years old. They have rich parents who are willing to pay for the whole thing. So I said, and I quote, "If you really want to drive a rally car, you should just do it. With yourself or with your friends. Don't worry about going pro. You're still rich enough and lucky enough to be able to do it. So don't complain at a party about the timeline and how you could have been better if you got in earlier. The best time to plant a tree is 50 years ago, but the second best time is today." Anyway, this is our second video on investing. Let's go. Warren Buffett says, buy a company you understand. Okay, thanks for watching, guys. See you next week. Just kidding. So, why would you want to invest? Well, as Ray Dalio says, cash is trash. The money that you leave in your savings account is barely keeping up with inflation and isn't really growing at all. Inflation basically is caused by quantitative easing, the process of printing money to encourage people to borrow and spend, which results in the devaluation of currency. That being said, if you're running a business, you have to understand the product. We're making a documentary series right now at Debutify, and one CEO that I've interviewed, she told me how she's been working on the problem of plastic packaging for 28 years. Now, if you're selling products, you need to know exactly how it ticks. Don't fall prey to these AliExpress get-rich-quick winning products. You need to be doing something that you understand, that you can explain to yourself and to other people. Well, the same goes for investing. Warren also says to ask questions. Of course, investing takes time, maybe even 28 years. Back to Warren. So he says to ask questions. Now, he's in a privileged position because he says to ask every CEO of an industry, but you might not have that privilege. But he asks them, if you could get rid of one company in their industry, which would it be and why? Pretty quickly, you're going to figure out who the best company is. When you're planning your product line or any investing in general, go and be in a room and just be in a room. Nobody should be swaying your decisions. Let the simple things come forward in your mind. What is the business? Where is it going? To try and understand this better. So let's take a look at the famous Moat Castle Duke analogy. But I did actually watch about 10 hours of Warren Buffett lectures from the 90s to really flesh out this analogy, because he talks about it in a few different ways. He uses See's Candy as a case study for what you should pay for buying a business. Berkshire Hathaway bought See's in 1972 for 25 million USD. It was selling 16 million pounds of candy at $1.95 per pound and making 4 million pre-tax. Real quick, a pound is about half a kilo, 500 grams. He and Charlie Munger basically had to decide if there was some untapped pricing power that they could sell candy at, maybe $2.25 a pound, then $30 a pound. That would make $4.8 million more in pre-tax profit, which would have doubled the earning power of the business. Even raising prices by a nickel, 5 cents per pound, would have produced a 20% gain in pre-tax earnings. So what's going on here? Basically, the product itself was very undervalued from the customer's point of view. Warren Buffett and Charlie Munger figured they could raise the prices and still maintain or grow volumes. So this is all very well and pretty cool, but people watching this video probably can't buy a company. I know that I don't have $25 million, but we can do one thing. We can buy a stock. In this TikTok Robin Hood world, it's important to zoom out and build some principles for investing before we get carried away with the gamification and speculation that's running rampant today. First principle. Why do we make irrational financial decisions? We have loss aversion, which means we get less pleasure from the things we gain than the pain that we get from things that we lose. So focus on the long-term results because of this. Don't trade. That person who tells you, oh yeah, I invested in lemonade when it was 4 cents, sold it at 5, I put in 10K. Yeah, that person's a gambler. Lemonade's over $100, so you want to think long term. What else to look for when buying a stock? Well, it needs to have a record of success, makes an attractive profit, can grow over time, obviously. Think about how the company works. Would I buy the whole company outright compared to a little slice if I could afford it? Because this forces you to ask more and more questions. That leads us to the next principle. How much would you pay? Well, you want to buy a company when it's on sale. Of course, that makes so much sense. Thank you, Connor. And to do this, you can do something called a margin of safety. This is a discount to the value of a stock. First, you have to understand the value. of the business. But before we buy into a company, we want to see a discount of 50%. Check out a free margin of safety calculator in the description. Now you have to wait until the time is right, until your price shows up. If you miss it, then you were wrong on your valuation and you have to learn from that mistake and try again next time. For example, Alibaba has been on my watch list for about a year. I've got a number in my head, and it just so happened to be $30 higher than the price that Charlie Munger bought in his recent chunk at. I didn't actually think it would go that low. Charlie bought it. I still haven't bought it because I'm kind of freaked out. You always have to be aware there's a major lack of transparency and regulation in the Chinese market. Phil Town says, quite rightly, investing in what you don't understand and can't predict easily is gambling, and that's all there is to it. Risk is going to come from not knowing what you're doing. Investing is a scale of risk/reward, and each person has to find the sweet spot for where they're comfortable to take risks. So me personally, I might get into Alibaba, but I'm also recognizing that I'm a young man, I don't know everything, and that it might be a complete gamble, and the Chinese government might just step in and, delete the company. Now, if you think that you're safe in the bank, let me enlighten you with the Howey test. The definition of a security offering was established by the Supreme Court in 1946 case called Sec versus J.W. Howey Co. In its judgment, the court derived the definition of a security based on 4 criteria. Firstly, the existence of an investment contract, the formation of a common enterprise, a promise of profits by the issuer, the use of a third-party offering to promote the offering. Banks aren't an investment as they don't meet these criteria. Putting your money in the bank will in most cases be deflationary. And with that, I wish you good luck with all of your investing. And that is that. Thank you for watching. Have a beautiful day. Get outside. Don't invest too much in meme coins. Thanks. See ya.